Hi students, my name is Carly and today's lecture will be on types and sources of long-term funds. If you have your textbook, you will need to refer to chapter 1. So the first question we need to ask ourselves is, why does a company need to raise long-term funds? What is the purpose? So what does a company use those long-term funds for? They will use those funds and they will invest them in strategic projects such as capital investments. Now, why will a company want to invest in capital projects? Because a company needs to create value for its shareholders. If a company is going to raise long-term funds to invest in capital projects, it is important that the entity sources these long-term funds at the correct cost and at the correct time. There are various types of long-term finance. We have ordinary shares, preference shares, bank loans, and bonds. We will look at each of these in more detail, starting with ordinary shares. Ordinary shares are issued to investors. Investors will buy these shares and will become owners of the company. Shares will have a face value, also known as the par value or nominal value. When an investor buys shares, as a result of owning these shares, the shareholder will have rights. Some of these rights include attending and voting at company general meetings on various matters. So a shareholder can vote on the appointment and re-election of directors. Shareholders will also need to approve any financing arrangements that involve a large issue of new shares, and this could happen if there is a takeover bid. The shareholders will also be involved in voting on the external auditors, and the shareholders will need to approve the company's remuneration for senior executives. So as a result of holding these shares, the shareholders are entitled to receive a dividend. However, this dividend cannot be decided by the shareholders. The directors will decide whether to pay a dividend and how much dividend will be paid. If a company is going to be liquidated, the ordinary shareholders will receive a share of the assets remaining after everyone else has been paid. Shareholders are also allowed to participate if there is a new issue of shares and can buy new shares to increase their shareholding. So those are the characteristics of ordinary shares. If we go to the next slide, we want to ask ourselves, where will these ordinary shares be presented in our financial statements? The company that is going to issue the shares will present this in equity in the company's statement of financial position. There are various advantages and disadvantages that needs to be taken into account with ordinary shares. The advantages are there is no obligation for the company to repay the funds. So if a company takes out debt, at some time in the future it will need to repay the funds. But if a company is going to issue shares instead of obtaining debt, then there is no obligation to repay the shareholders for the shares. Another advantage from the company's perspective is that the amount and timing of dividend payment is flexible, so there is no fixed dividend. So if we look at a loan, interest will have to be paid at a certain time, and so will capital payments. And here we can see how a dividend is different. Dividend payment is flexible depending on how the company is performing, and also the directors will decide if there is going to be a dividend and how much it will be. There are also disadvantages we need to take into account when considering ordinary shares. One of the things we need to consider is that the cost of equity finance is actually higher than the cost of debt finance, and there are various reasons for this. One of the reasons is that it is more expensive administratively to issue shares. Investors consider holding shares riskier than debt because in the event of liquidation, shareholders are paid last. We also need to think about tax implications. So dividends paid are not tax deductible, whereas interest payments are tax deductible. So interest payments can actually be used to reduce the company's taxable profits, whereas the same benefits are not obtained from paying dividends. Another disadvantage is that if new shares are issued and the current shareholders do not take up new shares in their current proportion, it means there will be a dilution in the ownership of the original shareholders. So ownership can always change in a company, so this is seen as a disadvantage. So that is ordinary shares. Now we need to look at another type of share. We are going to look at preference shares in the next slide. So if we look at preference shares here, let's have a look at the characteristics of preference shares. So just like ordinary shares had a face value, preference shares also have a face value, which is also known as the par value or the nominal value. Preference shareholders, though, have no voting rights, whereas ordinary shareholders had voting rights, preference shareholders have none. Preference shareholders also receive a dividend. However, this dividend is normally a fixed rate, and they know at the commencement and they know before buying the preference share what the fixed dividend will be. Another characteristic of preference dividends is that preference dividends are paid before ordinary dividends are paid. In the event of a liquidation, preference shareholders will actually receive the share of the remaining assets before ordinary shareholders, however, after all other debt holders and creditors have been paid. Preference shares could also have certain conditions attached. They could be redeemable, irredeemable, cumulative, and non-cumulative. And there are other possible conditions. For example, a preference share could be participating or it could be convertible. So if a preference share is redeemable, it means that the company will have to repay the principal at some time in the future to the preference shareholder, whereas irredeemable shares will never be paid back. If we have a preference share that is considered a cumulative preference share, this means that if the company does not have sufficient distributable reserves to pay the preference dividend in a current year, the entity will have to pay in future years when there are sufficient funds available. If a preference share is non-cumulative, this means that if there are insufficient funds or insufficient distributable reserves to pay the dividend in a current year, the entity will never have to pay that dividend it has missed. If we look at our other possible conditions, so preference shares can also be participating or they can be convertible. So what are participating preference shares? If a preference share is considered a participating preference share, it gives the holder a fixed dividend plus extra earnings based on certain conditions. So before the preference shareholder buys the share, it may be told that it will receive a fixed dividend of 1,000 Rand per share, plus it may receive 5% of net profit after tax. So if a share is participating, then it will get something in addition to its fixed dividends. Then if we look at convertible preference shares, so if a share is convertible, it means it can be exchanged for a specific number of ordinary shares at some time in the future. Then if we look at the presentation of preference shares, where will this be presented? So in the issuing company's statement, it will be shown in the statement of financial position. Depending on the conditions attached to the preference share will determine if it is classified as a liability or if it is classified as equity. So the deciding factor here of whether a preference share should be classified as a liability or equity in the issuing company's statement of financial position actually boils down to the conceptual framework. If the conditions of the preference share meet the definition of a liability, meaning there is a present obligation of the entity to transfer economic benefits, then it will be classified as a liability. However, if it does not meet the liability definition, then it will be classified as equity. So if we look at these examples here, if we have a cumulative irredeemable preference share, will this be a liability or will it be equity? So it's irredeemable, meaning that it will never be redeemed. However, it is cumulative, meaning that there is an obligation for the company to pay dividends in the future. Therefore, it meets the liability definition and will be treated as a liability. If we have redeemable preference shares, will this be treated as a liability or will it be treated as equity? Because it is redeemable, the company has an obligation to repay the principal to the preference shareholder. Therefore, there is an obligation, so it meets a definition of a liability. If we have non-cumulative irredeemable preference shares, should this be treated as a liability or equity? So it is non-cumulative and irredeemable. So non-cumulative means there is no obligation to pay dividends if they are missed. And irredeemable means that the preference shares will never be redeemed. Therefore, there is no obligation in this situation. So if we have a non-cumulative irredeemable preference share, this will be treated as equity. So there are various advantages and disadvantages for preference shares, just like there were for ordinary shares. So if we look at the advantages, we'll see that when the company issues the preference shares, this does not dilute the control of ordinary shareholders. And the reason for this is because preference shareholders do not have voting rights. So ordinary shareholders will not have any reduction in the dilution of their control, which is a good thing for the ordinary shareholders. Another advantage is that preference shareholders are exposed to a lower level of risk than ordinary shareholders. Therefore, preference shareholders expect a lower return. And the reason for this lower risk is that in the event of liquidation, preference shareholders are paid before ordinary shareholders. So preference shareholders, because of the low risk, they expect a lower return. The cost to the company of preference shares is therefore cheaper than the cost of ordinary shares. So a company may not be allowed to obtain additional debt finance. Perhaps they already have a lot of debt in place and they have debt covenants which prevents them from obtaining more debt finance. In that case, the company can issue preference shares as a way to obtain long-term funds without breaching those loan covenants. Now that we've looked at the advantages, let's have a look at the disadvantages. So one of the disadvantages is that the preference dividend payment is mandatory. So if a company has sufficient distributable reserves available, the company will have to pay a preference dividend. It is mandatory. If the company does not have sufficient distributable reserves available, if the preference share is cumulative, the company will have to pay in the future. So another disadvantage is that the cost of preference shares, although cheaper than the cost of equity, it is still more expensive than the cost of debt. So if we look at the preference dividends, they are unfortunately not tax deductible. So preference dividends paid by a company are not tax deductible, whereas interest paid on a debt is tax deductible. So this is a disadvantage of preference shares. So far we've looked at ordinary shares and preference shares as a source of long-term funds. Now we need to look at other sources like debt. So if we look at long-term debt, we need to consider the characteristics of long-term debt and how they differ to ordinary shares and preference shares. So if we look at long-term debt, one of the characteristics is that the providers of the debt finance are not the owners of the business. So they have no voting rights or say in how the business is run. They are simply providing debt. Another characteristic of having long-term debt is that the company has an obligation to pay fixed interest and capital payments. In the event of a liquidation, debt holders would be paid before any shareholders. So debt holders will be paid before any ordinary shareholders and preference shareholders. If we think about the interest paid on debt, interest is tax deductible, so the cost of debt is actually cheaper than ordinary or preference shares. So if we have a situation where a company has very low debt levels, it may be very easy for that company to raise debt finance. as opposed to equity finance, especially if the company is not a public company. So there are various types of long-term debt. We have bank loans, conventional bonds, convertible bonds. Then we have other types of bonds and security. So bank loans, what are the various characteristics of bank loans? So a bank loan is for a fixed amount and it is for an agreed period of time. This is pre-arranged. So when the company is taking out a bank loan, this will usually be specified in a contract. Then I'm sure you know if we have a loan, there must be interest. So interest will need to be paid on this loan, and this may be fixed for the period of the loan, or it could be variable. So if it is variable, it is set at a fixed percentage above the bank base lending rate. The interest could also be capped, where it is set at a certain level, and the bank will guarantee a maximum rate of interest, meaning the company borrowing the money will not have to pay above a certain level, say 10%, which is also stated in a contract. A bank loan will have a certain repayment structure, also specified in a contract. A bank loan may have to be repaid monthly, quarterly, or annually. So when a company takes out a bank loan, it will agree to a certain repayment structure where the capital payments will be made. If a company is going to be taking out a long-term bank loan, it is very likely that the bank will require security for this loan in case the company defaults on either the interest or the capital payments. There are various types of loan covenants. So a covenant can be a positive covenant or it can be a negative covenant. So a positive covenant usually involves a company maintaining certain financial ratios. So if you think about the debt ratios like debt to equity and interest cover ratio, usually a positive covenant will say the company has to keep its debt equity ratio above a certain level, and if the financial risk increases too high, then the company may recall that loan payment immediately. If we have a negative covenant, this will limit the borrower's behavior. So a negative covenant will prevent a borrower from borrowing from another bank or another lender, or it could limit the level of dividends a company is allowed to declare and pay to its shareholders. Another type of long-term debt is a conventional bond. So what is a conventional bond? It is a type of debt instrument with a fixed interest rate over a fixed period of time, and normally it has a fixed redemption value. So bonds may be issued by a company or they could be issued by the government. If a bond is issued by a company, this is known as a corporate bond. So there are various features of conventional bonds that you need to be aware of. So a conventional bond will be issued at par unless it is a deep discounted bond, which we'll look at later in the chapter. So a conventional bond is marketable, which means that it is quite easy for an investor to sell the debt or to sell the bond if they want to. Therefore, because of this, they will likely accept a lower return compared to the return demanded by a bank or a term loan. Conventional bonds are also usually redeemable. However, some bonds may be irredeemable. The next type of bond we are going to look at are convertible bonds. Another type of bond we have are convertible bonds. So convertible bonds are different to conventional bonds in that convertible bonds give the holder the right but not the obligation to convert their bonds into equity shares. So the bondholder can convert their bonds into equity shares at a specified future date. If the bondholders choose to not convert their bonds into shares, the bonds will be redeemed at maturity. So convertible bonds are often attractive to a company, and the reason for this is that the bondholders of the convertible bonds, they have a benefit in that they hold the right to convert those bonds into shares, and the value of those shares could be higher than the redemption value of the bond. So often this makes convertible bonds very attractive. Other types of bonds that we have are deep discount bonds and zero coupon bonds. Deep discount bonds. This is a bond, like the name suggests, that is issued at a price which is at a large discount to the nominal value. These bonds will be redeemable at par or above par when they eventually mature. Deep discount bonds will carry a much lower rate of interest than other types of bonds. However, the issuer of the bond will have to pay a much larger amount when the bond matures than it borrowed when the bonds were issued. So zero coupon bonds, these bonds are also issued at a discount. However, no interest is paid on them. Zero coupon bonds are actually an extreme form of a deep discount bond because no interest is paid on them. In the next slide, we're going to look at stock and bond markets. The first type of market we're going to look at is the capital markets. Or what are capital markets? So capital markets are markets for trading in medium and long-term finance for financial instruments. So financial instruments being things like equities and corporate bonds. So capital markets need to fulfill both primary functions and secondary functions. So how do these functions differ? So the primary function of a capital market is basically to enable a company to raise new finance by issuing new shares or new bonds. Often a company must be a publicly listed company to be allowed to raise finance from the public on a capital market. If we look at the secondary function of capital markets, this is to enable investors to sell their investments to other investors. Often investors are more willing to buy shares if they know that they can sell these shares easily. So if a share or security has good marketability, then there will be a demand for this because investors are more willing to buy something that they know they can sell easily in the future. So there are various advantages and disadvantages of a stock market listing. So before a company seeks a stock market listing, they need to take advantages and disadvantages into account. If we look at the disadvantages first, one of the disadvantages is that there is greater public regulation and accountability and scrutiny. So for the company, this is a disadvantage because there are certain legal requirements the company will have to face. So there will be more legal requirements if a company wants to obtain a stock market listing. If it obtains the stock market listing, it will also need to comply with the rules of the stock exchange. Another disadvantage of a stock market listing is that there will be a large number of investors. So there's a wide circle of investors, and each investor has its own wants and requirement. So this makes it difficult for the company to please all of its shareholders. There are also additional costs involved in a stock market listing, such as share issue costs, brokerage costs, commissions, and also underwriting fees. Now that we have looked at the disadvantages, let's move on and look at the advantages. So here we have a diagram showing the various advantages of a stock market listing. So one of the advantages is that it has improved marketability of its shares. So it is very easy for the company to sell its shares or issue shares because there are many people wanting to buy shares. A company would benefit from having a stock market listing because there would be more people wanting to buy its shares. Its shares are more in demand if it is listed on a stock market. There is also an enhanced public image due to the rules of the stock exchange and the greater public regulation and accountability. It is seen that companies listed on various stock exchanges have a better public image. Another advantage is that the original owners are able to sell their holding if they want to use the money for other projects later on. So it is very easy for the shareholders, it is very easy for the original owners to sell their holding if they want to use that money for other projects later on. If a company is listed on a stock market, then it is easier for that company to grow by acquisitions. It is also easier to obtain finance if you are listed on a stock market. So it will be easier if you want a loan and you go to the bank. Because you are listed on a stock market and you have greater public regulation, accountability, and scrutiny, the bank will be willing to lend you more, or more likely to lend you, than if you weren't listed on a stock market. If we go to the next slide, we can see the various ways of obtaining a stock market listing. There are 3 ways that an unquoted company can obtain a stock market listing. One of the ways is through an IPO, which is an initial public offering. The second way is through a placing. And the last way, if the company doesn't do an IPO or a placing, they can look at doing an introduction. So if we look at an initial public offering, what is this? So an IPO is where you have a company that wants to go public at large for the first time. So they are going to sell their shares to the public. It is going to be a large volume of shares. So how an IPO works is that an issuing house will publish an invitation to the public, and it will invite the public to apply for shares, either at a fixed price or on a tender basis. Another thing the issuing house will do is that they will often underwrite the issue. This means that for a fee, it will guarantee to buy any shares that are not sold to the public. So that is an IPO. Let's have a look at what a placing is in more detail. So a placing is different to an IPO in that the shares are not all offered to the public. Instead, we have a sponsoring market maker, and the sponsoring market maker will arrange for most of the share issues to be bought by a small number of investors. These investors are usually people or institutional investors. An institutional investor is something like a pension fund or an insurance company. So you can see that an IPO was an issue to a large number of shareholders. So you can see that an IPO was a large scale issue, whereas a placing involves a smaller number of investors, whereas an IPO involved a large number of investors. Then we have an introduction. So in an introduction, no shares are made available to the market. And an introduction is only possible where the shares in the company are already held widely by lots of different shareholders so that a market can be seen to exist. So how should a company decide between an IPO or a placing? There are various advantages and disadvantages, so depending on the requirements of the company will then decide whether it will go for an IPO or a placing. So placings are much cheaper than IPOs. So if you think about an initial public offering, there are underwriting costs and advertising costs that have to be incurred, and this is not the same for a placing. So placings are often used for a smaller issue. A placing is likely to be quicker than an IPO because remember, in an IPO, there's greater public regulation, accountability, and scrutiny, so it is likely to take much longer for it to work out than a placing. So placings are also likely to involve less disclosure of information than an IPO. Because of the greater scrutiny, accountability, and regulation, there's less disclosure of information needed. So the next slide we need to look at is to do with rights issues. Now you should have covered this somewhere along the line in accounting, but we're going to revise what a rights issue is. So a rights issue is when new capital is raised by giving existing shareholders the right to buy the new shares in proportion to their current holding. So if all shareholders buy the new shares in proportion to their current holding, there will be no change or dilution of ownership. So when we have a rights issue, to encourage the shareholders to buy these shares, the shares under the rights issue are usually issued at a discount to the market price. So the company will want to ensure that the issue price is set low enough to encourage the current shareholders to buy the shares, but not so low that the earnings per share is excessively diluted. So what is the reason that a company would want to issue shares to the current shareholders rather than issue to new shareholders in the public? One of the reasons is that the company will need to raise finance, and it is cheaper to raise that finance by performing a rights issue and allowing the shareholders to buy new shares rather than issuing to the public. So the main reason is that it is cheaper, but there are still underwriting costs that need to be paid. So the existing shareholders have 4 courses of action. So the company will offer new shares to the existing shareholders at a discount to the market price. So the current shareholders can either buy these new shares so that their control won't be diluted if they buy it in proportion to their current shareholding. They could also sell their rights to buy these shares under the rights issue. They could sell enough rights to finance their share purchases, or they could do nothing. So what is the impact of the rights issue on the share price? If a rights issue has been decided, then it will be announced. So after a rights issue has been announced, the impact on the share price is that it will usually fall, as it is uncertain what the outcome of the rights issue will be. There is also uncertainty about the future profits and future dividends of the company. There are a few terms we need to understand when we are dealing with rights issue. So when a rights issue is announced, all shareholders have the right to subscribe for these new shares, and there are rights attached to the shares. This means that the shares are traded cum rights. Or if the shares are traded without rights attached to them, in other words, the rights no longer exist, the shares are said to be trading ex rights. We can also calculate something called the theoretical ex rights price, abbreviated into TERP. So the TERP is a theoretical weighted average price after the rights issue, assuming that all the newly issued shares are taken up by all of the existing shareholders. So the TERP price assumes that all the existing shareholders are going to buy shares from the rights issue in proportion to their existing holding. This will therefore result in no dilution of shareholding. As we are looking at bonds as a source of long-term finance, we also need to understand how these bond markets work. Corporate bonds are mostly issued on the primary market, and the issue of these corporate bonds is usually underwritten. Remember, we discussed earlier what underwritten means? It means that if the public do not take up these bonds, then the underwriter will usually take up these bonds and purchase them. So the underwriters usually consist of banks and financial institutions. So they will buy the issue of bonds and then they will sell them on to investors. If there are some left over, some bonds left over, then they will usually purchase those bonds. So like I said earlier, bonds are often bought directly through financial institutions. This is termed over the counter. So this means that they are often not under the supervision of recognized exchanges. So if they are bought from financial institutions, they are termed as trading over the counter, as opposed to being bought and sold on recognized exchanges. There are recognized exchanges though, such as the London Stock Exchange or the New York Stock Exchange. However, mostly they are traded over the counter with banks and financial institutions. If it is decided that the issue of bonds will take place on an exchange as opposed to over the counter, then there are various things that need to happen. A prospectus must be prepared, and this prospectus needs to be approved by the listing authority so that the bonds can be admitted for trading. So once the bonds are approved, they can be traded on the exchange and they can then be resold on secondary markets. So the bond market can be broken down into 3 main groups. So we have the issuers, we have the underwriters, and we have the purchasers. So the issuers, they sell bonds in capital markets to raise the required finance. These are usually governments, banks, and corporations. Then we have underwriters. So the underwriters help the issuer to sell the bonds in the market. They usually consist of investment banks and financial institutions. Then we have the purchasers of the bonds. They buy the bonds and will hold these as an investment. So buyers can be anyone from government, banks, corporations, as well as individual investors. The next slide is going to look at the role of advisors. So often when we raise finance on a capital market, there is certain information that needs to come from a wide range of experts to ensure that it happens smoothly. So we have sponsors, book runners, reporting accountants, we have lawyers, and financial public relations firm. So what is a sponsor? What role does a sponsor play? So a sponsor is usually an investment bank or a large accounting firm. So a sponsor will have various duties to ensure that the raising of finance goes smoothly. So a sponsor is usually an investment bank or a large accountancy firm, and they will be the lead advisor or the chief advisor in an IPO. So of their functions include managing the IPO project. They will have to coordinate any due diligence, and they will also have to draft the prospectus to be issued. They will want to ensure that the company is complying with all of the necessary rules and regulations. Then we have a book runner. So a book runner is the main underwriter of a group of underwriters for new share and debt issue. So the book runner usually consists of a financial institution. So the roles the book runner does is they will raise finance from investors on behalf of the company. They will also help to determine the appropriate pricing of the shares or debt to be issued. And they will also guarantee to buy unsold shares or debt if it is unable to find enough investors. Then we have the reporting accountant. So the reporting accountant, they would review and report on the company's readiness for listing. So usually the reporting accountant will be engaged to review and report on the company's readiness. So if the company is not ready and the prospectus is found to be declined, then the directors bear legal responsibility for the integrity of the listing documents. So both the directors and the lead advisor risk considerable damage to their reputation if the prospectus is declined. So of its responsibilities, the reporting accountant would have to report as to whether it can meet its reporting obligations as a public company after it is listed. The reporting accountant will also have to give an opinion on the company's financial records. The reporting accountant will also need to consider working capital and whether there is enough cash flow available. A lawyer will perform all of the legal duties and any due diligence. They will also be responsible for drafting the prospectus and providing any legal opinions that are required. Then we have the financial public relations firm. So usually a financial public relations company will be appointed, and it is necessary to ensure that an appropriate communication strategy is developed, both before the IPO and after the IPO. Usually a financial public relations company will be appointed, and this is very important because they will be responsible for developing an appropriate communication strategy both before the IPO and after the IPO. Right, students, that is the end of this topic. There is another lecture on cost of capital. If you haven't watched that lecture, I strongly recommend that you go to that topic next. Thank you.